So again, to turn to some of our professionals out in the field, the industrial market has ridden the wave, and there's no one who's seen that wave as closely as Ed Bull. So please join me in welcoming Ed Bull to the stage. Welcome, Ed.
Thanks, Stats, man.
Okay. Now, Ed, let's see. The industrial market, there was quite a flood of stock onto the industrial market last year and early this year, and all of a sudden it seemed to sort of dry up. What sort of caused that, and how do you see the market at the moment?
Yeah, well, when we were at the Market Outlook breakfast last year and through to the start of 2009, we saw around $350 million worth of investment-grade stock on the market. That was mainly through the LPTs. Very little of that did transact. It wasn't formally on the market. Those that did go to a formal marketing campaign did see some success. But at that time, we had the private investors were looking for long-term lease. They're also looking for 9% plus, good covenant, good location. Since then, I think we had a few of the astute industrial investors did pick the eyes out of the market. They did see the quality stock. We have seen some deals transact around the 8.5%. So I think that gap has closed a little bit. And we are seeing there are still some non-core assets for sale through those property trusts. But all up, we've seen, in 2009 alone, we've seen $257 million worth of investment-grade stock over 5 mil transacted, so it's still healthy. I think there's still more in due diligence now through till Christmas, and I think we've stabilised on yields around that average about 8.5. I'm a little bit more bullish than yourself there, and secondary anywhere from 9 plus. Okay,
I mean the industrial market's quite a it varies a lot. I mean we use generalisations, use metro averages a lot, but there's a lot of variation. Especially in rents from place to place. How do you see that at the moment?
Well, rents, generally, we've seen face rents come off anywhere 10 to 15%. We see that stabilising now. Incentives have come off anywhere, have been introduced, at around 10 to 20%. And they've been a big thing this year in terms of getting stock away. Going through to 2010, we see face rents stabilising where they are, and incentives drying up a little bit.
Okay, so you've talked about how private investors have been dominating the industrial market. What about owner-occupiers? Have they been there given the low interest rate environment?
Well, we haven't seen owner-occupiers for 12 to 18 months, but I can say that since June 30, we definitely have seen them come back into the market, basically picking up buildings vacant possession that may have sat there for the last 12 months. They've seen the repricing and capital values come down 20 to 30% on that product, so they're now seeing value in that and they are making the move. The level of inquiry has picked up considerably since June 30, and they're also now starting to look at land as well.
Okay, that's a good point, land. I mean, that's one of those areas where there's an enormous amount of variation in demand and style and price. I mean, so what's your sort of take on the land market at the moment across Brisbane?
Well, it was a great place to be in 06, 07. It's been in limbo for quite some time. Again, those people that had the land holdings that was completed and sitting there and did reprice earlier this year are now seeing the advantages of that. We again see the pickup in owner-occupier activity and pre-lease activity in certain areas. You have a look at in the southern corridor, for an example, Southlink has transacted 84,000 square metres of land since June 30, which is significant. Also doing 44,000 square metres of land for pre-lease opportunity, and Radius similarly 30,000 square metres since June 30. So that's a huge increase and seeing those people back in the market that we haven't seen for 12 to 18 months.
Okay, so what about infrastructure? We used to be the catch cry. We've sort of forgotten about infrastructure for 12 months or so, but clearly there's a lot more coming through the pipeline in infrastructure. Do you think we'll get back to the situation where, look, just follow the infrastructure and you'll find the industrial opportunities?
Yeah, for sure. I think Well, your biggest drivers for industrial property are always infrastructure and employment base. So that is very important, and the huge amount of spend going on at the moment. So you've got to look at those areas. You know, Eagle Farm, Gateway Precinct will always be underpinned by that infrastructure and also the lack of land in that area, but you've got the duplication of the Gateway, Airport Link, the upgrade of the roundabout there. That'll all underpin values there, and you look further afield and you look at the Western Corridor, Centenary Interchange, and anywhere along the Logan Motorway is going to be successful going through to 2010. Okay,
so you still see, you think the industrial market's now adjusted and you're ready, it's time to get back into that market?
Absolutely. I think we were the first to go on yields in terms of blowout on yields. I think we're the first to stabilise. I see land coming back into play, which we haven't seen for 18 months. That's all due to the repricing and owner-occupiers seeing value and taking the plunge. So I think it's going to be solid through to 2010 and through to the end of the year. You're going to see a pick-up in inquiry, which we've seen, and that'll flow through to deals and construction activity.
Okay, Ed, thanks very much for those insights from the coalface. Please join me in welcoming, thanking Ed Bull. Thanks, Ed.